One of the most exciting brands in the world right now isn't some flashy meme stock making waves on Reddit. It's not the latest AI startup that's guaranteed to change the world overnight. Instead, it's a real business with real products, real customers, and potentially a massive runway for growth. Now, before you think this is just another hype piece, let me be clear. This isn't about chasing the latest fad or riding a stock just because it's trending on Twitter. This is about value-based investing. It's about doing the work, understanding the business, and buying when the numbers actually make sense. The company we're talking about today has been quietly building its empire in one of the most resilient sectors of the economy, healthcare. It's not only growing fast, it's disrupting the traditional way people get their healthcare. But before you get too excited, let's set the stage. The stock in question is HIMS and HERS Health, ticker symbol HIMS. If you've been watching the market this year, you might have noticed something interesting. HIMS is up an incredible 155% year-to-date. That's a jaw-dropping move for any stock, let alone one in healthcare. But here's the catch. The ride hasn't been smooth. Like most stocks, HIMS has seen its share of ups and downs. Headlines about new product launches send it soaring, while market jitters or missed earnings expectations can pull it back down just as fast. For long-term investors, that kind of volatility can be nerve-wracking. But for value-minded buyers, it can also mean opportunity, if you know what you're looking for. And that's where our philosophy comes in. Value investing is not about guessing the next viral stock. It's not about buying something just because everyone else is talking about it. As Warren Buffett famously said, price is what you pay. Value is what you get. Real investing is about buying great businesses at fair prices and holding them until the market finally recognizes their worth. That means focusing on real cash flow, not just revenue projections, sustainable business models, not just fancy marketing campaigns, and buying when the price is right, not when the hype is loudest. HIMS and HERS is what I'd call a health tech disruptor. The company operates in the booming telehealth sector, providing direct-to-consumer healthcare products and services. Everything from dermatology consultations to mental health therapy to treatments for hair loss and erectile dysfunction. What makes them stand out? First, they've mastered the subscription model. Once they get a customer, they tend to keep them. In fact, after 2 years, 85% of their customers stay subscribed. That kind of retention is gold in the business world. Second, they're expanding aggressively into high-margin areas like mental health therapy, dermatology, and weight loss treatments, including GLP-1 drugs, the same category that's driving massive excitement for companies like Novo Nordisk and Eli Lilly. Third, their brand visibility is phenomenal. If you've watched TV or scrolled through Instagram, you've probably seen their clean, approachable ads. They know how to reach their target audience. And more importantly, they know how to turn that attention into paying customers. Let's talk numbers, because numbers don't lie. Market cap, $15.8 billion. Enterprise value, essentially the same as market cap, which tells us they have almost zero debt. A rare and beautiful thing for a fast-growing company. Gross margins, around 77%. That's the kind of margin you normally see in software, not healthcare. Revenue growth, over the past 3 years, they've averaged a 77% CAGR, compound annual growth rate. Over the past 5 years, an amazing 100% CAGR free cash flow. Last year alone, they generated $236 million in free cash flow. Their 5-year average is about $44 million, meaning they're accelerating fast. Price to free cash flow ratio, around 66x. Yes, that's high, but when a company is growing this quickly, you can justify paying a premium. Of course, it's not all sunshine and rainbows. One major risk for HIMS investors has been share dilution. Back in 2019, the company had roughly 35 million shares outstanding. Today, that number has exploded to about 222 million. Why does that matter? Because dilution means your slice of the pie gets smaller over time. Even if the company makes more money, your ownership percentage shrinks. The good news? As their cash flow improves, they're relying less on issuing new shares. The trend is slowing, which could mean less pressure on existing shareholders moving forward. If you're sitting there thinking, I don't fully understand free cash flow, market cap, or dilution, don't worry, you're not alone. That's why we put together a free PDF guide breaking down all the key financial metrics every investor should know. The more you understand these basics, the easier it is to avoid bad investments and spot the great ones. Now, let's see what the analysts think. Current projections for HIMS show earnings per share growth in the range of 24 to 43% over the coming years. Revenue growth estimates are a bit wider, anywhere from 15% to 60%. That's a pretty big spread, which tells us there's still uncertainty in how the market views this business. But here's the thing, HIMS and HERS has been outperforming estimates for a while now, largely because of how effective their marketing is. If they keep acquiring customers at the same rate and retaining them, those higher-end growth numbers might not be unrealistic. For those of you who trade based on charts, here's the reality. HIMS is volatile. This is a stock that can move sharply in both directions on very little news. If you're day trading it, using something like a 15-minute chart can give you a better read on momentum and entry points. But for longer-term investors, probably not the kind of stock you want to hold overnight if you're looking for stability. This is a high-growth, high-volatility play, not a steady dividend payer. Now let's value the company using our stock analyzer tool. Here are the assumptions we'll use. Revenue growth, 10% on the low end, 30% on the high end. Profit margin, 10% to 30%. P/E ratio, between 16 and 22. Desired annual return, 9%. With these numbers plugged in, here's what we get. Low estimate, $30 per share. Mid estimate, $117 per share. High estimate, $385 per share. Right now, the stock trades at about $65. Based on our mid-range calculation, that's around a 16.5% potential upside. Of course, this doesn't factor in the effect of future dilution, so actual returns could be lower if the share count continues to rise. This is where we come back to philosophy. It's easy to get excited when you see a stock double or triple in a short time. But the best investors aren't chasing what's hot. They're sticking to a process. They research the business. They understand the numbers. They buy with patience. And they hold with discipline. The market will always try to tempt you with shiny objects. Your job is to stay focused on your plan. If you found this video helpful, don't forget to subscribe and tap the bell icon so you never miss an update. I'll see you in the next one.